Okay, targets. We talked a little bit about stops, let's talk about targets. This is a really subjective topic, guys. So we're going to talk about three kind of broad ways to play for a target. Now, a lot of people are just going to say, especially if you're swing trading, you're going to say, listen, I'm in the trade, I'll come out when I feel it's ready, which is fine, and I understand that, and I get that, and I guess if you're at a really high time frame, that makes a lot of sense. But I still think it makes good common sense to be prudent in the boundaries that you're putting around the trade. So if you're saying, listen, if I'm trading based on a good earnings cycle and they start to perform badly, then I want to come out. If I'm trading on the fact that price actions continue to go higher, if we stop being an uptrend and we start making some lower lows, I'm going to come out. Even if you make it broad, then I think that makes sense. But let's look at it from a kind of short-term trading perspective. The first one you've got is X times your risk. That's very simplistic. It makes perfect sense in some instances. So let's say you're risking 10 ticks and you're day trading, or let's say you're risking 150 ticks and you may be swing trading. You may well say to yourself, well, actually, I'm looking for a multi-day move. The average range on the day is 100 ticks. I'm looking for a 3-day move, so I'm looking for 300 ticks. So that's going to be 2 times my risk, so 300 ticks. So very simplistic based on your risk. Maybe 10 ticks you're scalping, you're looking for 15 tick profit. Maybe it's a very decent probability of working or something like that. So I don't think that's a very good way of doing it personally. I think there's better ways out there, but it's a little bit of a, that's better. I think there's better ways of doing it. Let's look at this way, which is a price-based target. And if we use a red pen, we won't have that issue there. A price-based target. This is I think the best way of doing it. So what is a price-based target? So if you can imagine, we've got our chart here, and we are taking, let's stick with a long scenario. Let's say we've opened here, we've come lower, we've kind of double bottomed, and you've gone long here. You've recognised this. You've put your stop there. We'll talk about stops today. And you're thinking, well, you know what? Where's my target? Well, what you can ultimately do is say, well, actually, we've only done 70 ticks range. The average true range on the day is 100. So if that is genuinely the bottom, we're probably going to go another 30 above. So it makes sense from a logical perspective, and this is why you can't just arbitrarily put it, to say to myself, you know what, all the facts, if that's right and the premise is right, which is obviously the big thing in trading, if my double bottom is holding, if that does hold and I'm correct, and the daily range is going to be in line with what we're normally doing, then that becomes a fairly sensible target. Perhaps you might lower it and say, well, you know what, that's a key level, that at prior high, I'm going to take it out just before the high, because I think that's a higher probability of doing it than the last 30 ticks, whatever. But again, it's all structured around how you would like to take the trade. It's all structured around the pattern that you're trading, structured around all those kind of things. You can't arbitrarily give your target a number and then just expect it to hit it. If you're on a daily chart, for example, the market's pulled lower on a daily chart, it's starting to pull back, it's consolidating, then the chances of it continuing to the lower are quite high. But perhaps if you've got earnings coming up soon, the chances of it really getting going until after earnings are quite slim. So it doesn't make sense to have your target right down here, and the time frame isn't enough for it to do it. So it's putting this common sense when you've got your price-based target. Okay, so let's look at, and that actually, just very quickly, that really comes into play when you're talking about breakout scenarios. If the market's coming up and it's breaking out of a key level, you've got to look at how far the whole thing has stretched as well before you have your target. If you're having a target up here, that may well work, but expect under normal market conditions for this thing to pull back a little bit more, unwind a little bit more, and then go to it, as opposed to going straight to it. So you've got to have some sense based on how volatile your market is, what the normal range is, what the normal conditions are, and all that kind of thing before you use a price-based target. But I think that's the best one. Another one is price action-based target, and this is if you're trading based on price action, trading based on tape, just trading based on that kind of thing. What you want to see here is something that is basically changing the sentiment of the market. So if you've been long, let's say, we'll stick that example, you've come up and the thing just starts struggling a little bit at highs, you've got a reasonable range already. All the other things are indicating maybe it's 12 o'clock, one of those sorts of lunchtime, one of the sort of times it might unwind a little bit. All these kind of things may well say to you, listen, I didn't have an actual number in mind, but it's moved up and it's kind of struggling now, the price is struggling. I think I'm going to be prudent enough, I'm going to take it off. So you might say, okay, that's me done. That's purely based on the price action. If you were trading, let's say you were trading a breakout down here, so you went short here, but all of a sudden it's kind of spiked back up and was holding back above that key level line, that may well not be enough to stop you, but you might say from a price action perspective, you might say that is not really, that's looking more like a fake out than a breakout. I'm going to come out of the position. I'm not going to get involved in it anymore. I want to ditch it because it just doesn't look like it should do. The premise is incorrect. So those are the three key ways of assessing price targets. Another way you can do it, which I didn't put on here, is if you use something like a fib. So you've got your fib, and I'm just going to guess really here about the lines. You can kind of use things like extensions and other ways of extrapolating where you would expect the price to go. It's pretty similar to price-based target, because you're saying, that's the high and I'm expecting it to go another 25% or another whatever percent you've got it set at. And that's kind of where I'm going to go. There's actually a complete general study about that. I've been very, very broad because it's not something that I use. But if you want to investigate, you go ahead and look on Google and check it all out. But that's the kind of thing that can help you frame it. And I'm not that much of a fan of this kind of thing, because what do you do if the price gets here and then just looks like it's struggling? Let's say it just can't get above that for 2 hours or something during the day. Do you hold out for the last 4 ticks, 5 ticks? It doesn't make sense. The risk reward suddenly gets massively skewed as the trade has gone in your favour. So something to be aware of, something to think about, something to look at when you're structuring your trade from targets and stops.